Welcome, everybody. Evan is an old pal of mine. I don't know how many years we go back, Evan. Like, is it the
A
decade?
decade? Yeah.
Yeah, golly, must be. Well, at the current time, he's the founding executive director of the UC, University of California Center for Business Law in San Francisco. You know, the corporate governance in the United States is all about law, has nothing to
hmm
do with how boardrooms actually work. But Evan's at the center of Silicon Valley, has been there forever, and started the Stanford Rock School's program for startup directors. So he's right in the middle of all of this and a hugely experienced executive in his own right. So, Evan, I'm going to give you the floor to take us through some of these weird new constructs that are occurring in the United States, like a public benefit corporation or a long term benefit trust or standard ownership, and on it goes. Very weird things. So, Evan, thank you for being with us again. Great to see you. And away you go.
Okay. David, it's great to see you again. I have to say, you are a visionary yourself. You called this the AI tsunami back in whatever, 3 or 4 years ago. And here we
Yeah.
are. The tsunami is still going, and you're well in advance of all your peers in thinking about these topics. And I have to say that it's even hard to keep up here in Silicon Valley. There's a lot of stuff happening. And what I thought I'd do today is just give you a little bit of some of these topics so that we can discuss. And I know there's going to be a lot of questions. It's these figures keep changing, but the idea is to talk about what in Silicon Valley we call the big tech and the little tech agenda. And I'll describe what is little tech. Is it really little? And big tech as well, because that's an important part of the story. The AI boom, I think everybody is aware, and we'll talk about that both in venture and in public companies. I think this is not stopping at all, and we keep adding numbers, figures, zeros. We were talking billions before, now we're talking trillions. You know, the zeros keep adding up. And I'll talk about this innovation in corporate governance, which is really what we do, David, where a
Mhm.
lot of these companies have innovated their own corporate governance. So where we used to have a C corp, a traditional company with a board of directors, a CEO, and now what we're doing is we're looking at alternative structures like public benefit corporations, like long-term benefit trusts, and other issues. And clearly the biggest one and the oddest one is OpenAI, which started as a nonprofit, but recently converted to a public benefit corporation. And we're having a trial coming up here next to where I am in Oakland, federal court between Musk v. Altman, and that's going to be a big one. So first, let's talk a little bit about Magnificent Seven. So we've all heard about this Magnificent Seven. These are the large hyperscalers. Now we are in 4 trillion, 5 trillion valuations for these companies. Tech companies are dominating everything. If you think about it, they all started as venture-backed companies. So they all are from startup innovation, from venture capital backed origin, and they're really now the behemoths of the United States in terms of leading the market. The impact of these companies, $22 trillion today. It peaked at $24 trillion. These seven companies, that's about 33% of the S&P 500. And people are thinking, look, there's a big concentration of these companies in the market, and they're leading a lot of the innovation. These hyperscalers are investing a massive amount of compute power, cloud infrastructure. Google, Amazon, Microsoft, Meta, the capex they've said this year is 700 billion just annual expenditure. So it's huge. David and I were talking before going live that the expenditure on all these costs are about 9 trillion in data centers. So this is really a massive number, and it's driving a lot of what's going on in the market. And on the governance side, what I think is interesting is a lot of the focus has been on public company governance. But the reality is that you got to go a little bit lower into the startup governance to understand, dynamics. It's a very different environment depending on what stage you are, and the frameworks. And I think people who traditionally do governance in public markets don't have the experience or don't have the window into how these dynamics play out in the private markets. And I have to say that this latest generation of companies is a completely different generation. So OpenAI and Anthropic and Inflection AI and everybody else is using a different playbook, and that's something that we have to discuss. If I make you guess, what are the number of venture-backed companies in the S&P 500, David, what's the percentage of companies in the S&P 500 that were venture-backed?
Whoa, 30.
That's a good guess. It's about 20%. Maybe now we're into 30. Here's a slide from my friend Ilyas Tribulayev from Stanford Business School. And you can see how even the largest ones I just mentioned were all venture backed. So they have it's a small industry, venture capital, 1.3 trillion of assets under management comparatively, right? But they have a big economic impact in the market. And I think that's important to recognize. And what's happening is now this agenda that we have to protect the startup economy. And they've come up with this term little tech. And I'll describe this, right? So all these companies that we are seeing now, right? OpenAI and Anthropic and all the others, Databricks and others are really driving a lot of the interest and movement in the market. So there's about 1,344 unicorns, $6.4 trillion of cumulative valuation. Big question mark on how many of those remain valuable. A lot of people say that this is inflated valuations. This comes from the 2021 no interest rate environment. In fact, a lot of the class of 2021 IPOs are really hurt, and that they're not doing very well. And so that's a good question mark, but they're still very strong, and there's still all this unicorn pent up demand. Private assets, right? So this is something that we have to realize. In 2012, it was considered to be about $9.7 trillion. Now it's 22 trillion, right? Bank of America said that in the year 2000, it was 1%, and now it's 8% of the total market. So if you think about the value in the private markets versus value in public markets, the private market is really driving a lot of the value. And they say by 2032, right, it's going to reach 60 to 65 trillion. So that's about 30% of all assets under management, according to Bain, right? So that's something that in Silicon Valley, people have very internalized. People want to be in the private markets, right? So, and there are variations. There are things that have happened that have made this possible. Just to give you a comparison, there is about 6,000 publicly listed companies in the US and about 60,000 venture-backed companies and about 12,000 PE-backed companies. I typically think of PE as an asset or as an industry different to venture capital, although they're all private-backed companies. But the way that you manage a private equity-backed company is different than the way that you manage a venture-backed company. And there are different sizes, right? Venture capital, I mentioned 1.3 trillion of assets under management. PE is much larger, right? $9 trillion. And these are the big funds, buyout funds, KKR, Blackstone, Apollo. They have a much bigger size and also impact because the companies they have in their portfolio are way larger than the startups that are in venture. And the governance of venture capital is very different to the governance of private equity. If you take the typical board of a venture-backed company, you'll have one or two founders, one or two VC investors as they come on board, and maybe an independent director. In the private equity context, what happens is they typically acquire a majority or the control of the company or 100%. So you have maybe one or two investing partners, one or two operating partners, and maybe you'll add independent directors that are industry experts. And the timeline is very different because in the startup economy, what's happened is even though it used to be that you'd take maybe 6-10 years to go public, now it's actually 12-16 years on average. Whereas in private equity, the playbook is very strict. You take the company private or you buy a company and you got to exit in 5 years, right? That's the model, and that they have a very strong financial focus on doing that, right? And they have different ways of doing. There's a lot of acquisitions, even among the firms. And so this, I think, is a different item. Now, one thing that has allowed the growth of private markets is this growth of secondary markets. So what happened is that because these companies were staying private for longer, so like let's take Facebook as an example, right? Facebook started in 2004. By 2008, right, you'd have engineers with stock options that have vested for 4 years, but those stocks, right, those shares are not public. So people started thinking about how can we provide some liquidity? How can we, broker into these assets? And they started creating these secondary markets. And these secondary markets are essentially where people buy and sell shares of private companies. And today, so this is a slide from last year, third quarter of 2025. You can see that the way that US VC exits have happened is traditionally it's been IPOs and it's been M&A transactions. So those are both were about $100 billion. But secondary markets have grown to almost the same amount, right? So you got about $80 billion of direct secondaries and $14 billion in GP-led secondaries, where funds need to take their own portfolio companies and sell them into the secondary market. And this has allowed to provide liquidity to founders, to employees, to investors, and remain private, right? So these are typically tender offers that companies do. And so if you think of a SpaceX, right, which is one of the largest private companies, they've regularly done tender offers to provide liquidity to their employees and to investors on an annual cadence. And so I think this is a big change and it allows companies to stay private. Now, there is something that we call the power law, which is really the king law of Silicon Valley, meaning that all the returns are going to be driven by a very small percentage of companies. And that's true in secondaries as well. So the top 5 startups, so take OpenAI, Anthropic, SpaceX, and others, drive about 60%, 65% of all secondaries. And so that's also very concentrated. If you look at the slide here, which is interesting because it says valuations, market cap of these private companies, you see OpenAI there at 650 billion. Well, it turns out they just closed at $122 billion round, pre-valuation of 730 billion, post-valuation of 852 billion. So things change by orders of magnitude here, but you can see that these are a lot of the companies that didn't exist, by the way, David, even 3, 4, 5 years ago. So now we have companies that are worth 10, 20, 50, 100, 500, and almost $1 trillion, that this is a new market. And this is where you are moving around a lot today, which is the AI market, right? So a couple of things that are really interesting is there's so much demand for these companies that now we have seen these closed-end funds offering private shares. So Robinhood, which is this broker in the United States that is very popular within retail investors, on March 6th, so just a month ago, not even a month, 3 weeks ago, went public with this new vehicle that essentially what they do is they hold about 10 private companies. So Databricks, Revolut, Mercor, Airwallex, Boom Supersonic, Over, and Ramp is in the holdings of this company. And you have retail investors that pay, it went public at, I think, $22 per share. And you betting there's no other way for me to get access to these private companies. Therefore, I'm going to buy this. And so it's about $700 million of assets under management. It's done about 20% of return. And now they're saying they're going to add Stripe and 11 Labs. And so this is one way that people are getting liquidity, or at least are getting access or exposure to these companies that otherwise are not open to the regular investor. The other one, which is more controversial, is Fundrise Innovation Fund. This company on March 25th, so what are we, like 5 days ago, 6 days ago, was valued at $522 per share when it went public at $31. So 1,500% return on March 25th. Now you can see it's dropped. So now I think it's at 129. So it's very volatile. But what happens here is if you take the NAV, right, the net asset value, it's really low. It's about $19 per share. So there's an over demand. People are betting that this, is very valuable. I think you got to be very careful about this because it's very frothy, right? It depends on popularity. They also have, Anthropic, Databricks, OpenAI, Anduril, Ramp, SpaceX, Epic Games, Flock Safety, and others in their portfolio. So it's a way, it's kind of, some people have called it like the mini IPO of Anthropic before the IPO, right? It gives you a sense of what's going on, right? So I think this is an interesting trend and it shows you what's going on. And remember, in the US, the chair of the SEC has talked about making IPOs great again. And, part of it is trying to unlock this value to the market. Now, interestingly here, this slide is amazing. Here you can see how the largest private fundraisings have dwarfed the largest IPOs in history. To give you context, the largest IPO in the history was Saudi Aramco that, was $25 billion it raised. OpenAI just raised $122 billion. So that's over 4 times larger in the private markets, right?
Mm.
So this is an incredible slide to me because it shows you how what used to be necessary, which was to go to public markets to raise this amount of money, is not necessary in today's age. And you can raise all this money in private markets. Now, interestingly, people are talking about SpaceX going public, OpenAI, ByteDance, Anthropic. What's fascinating always is Elon Musk. He says not only is it going public at 1 trillion, they're talking about $1.75 trillion, raising $75 billion in the IPO. So that would be 3 times larger than the Saudi Aramco IPO. He's also saying that 30% of that would be allocated to retail investors. And he wants to unlock, he doesn't want to have a 6-month lock period. So this to me is very interesting because we're talking about this narrative in Silicon Valley for the last maybe 10, 12 years. There was a narrative of stay private for longer.
Yeah.
You know who didn't like that? VCs didn't like that because VCs loved IPOs because that's the primary way you get your money back and returns, and that's good. But also people arguing, look, it's good to be in the public markets. It gives you discipline of the market. It gives you a grown-up corporate governance structure. But the pushback there is, look, you have to deal with much short sellers, activist investors, SEC regulation, plaintiff lawyers, short-term demands. And so like there's a lot of discussion about this question of staying private versus going public. Now, if I think SpaceX is interesting. Elon Musk is interesting because he gets the Elon Musk premium, right? Tesla is valued, I don't know what's the number of PE, but it's $1.3 trillion now. So he gets a big premium. The question is whether if you go public, how the market is going to value. So obviously these companies have a lot of demand, and we'll see what happens with IPO, Anthropic, and the others if they go public. But this is a big issue going on in the market. So if we talk about the AI boom, all the venture money, so about 70% of all venture money is going to AI, right? Here is a slide from Financial Times from September saying $161 billion in venture capital going to AI. It probably rounded out to $200 billion at the end of the year. And the number of companies that are in this race, here you have a list of 10 companies that are $1 trillion, but the reality now it's probably 3 trillion. And so the change and the growth of these companies is something that we haven't seen, I don't think, ever. And then the governance side is very interesting. I always like to tell the story of Thinking Machine Labs. That's the last one, or the second to last one in that list. Thinking Machine Labs was founded by Mira Murati, who was the CTO of OpenAI, who became the CEO for a weekend of OpenAI. And as she started this company, she left OpenAI with a few other OpenAI people, raised, I think, $2 billion at a $10 billion valuation with no product, David. So she's like, hey, I'm doing my own startup. I'll do a seed round. Instead of getting, $10 million, $20 million, she's getting $2 billion. But she has 100-to-1 voting shares. She outvotes every other board member forever. She's got voting agreements with all the other board members, and it's a public benefit corporation. So the stringent form of control that you've ever seen. And recently, maybe about a month ago, there was a story where a lot of the co-founders decided to leave and they went back to OpenAI. So essentially, you've got all these investors that gave $2 billion, but handed her the keys. And it's like, okay, you do whatever, and we have no recourse to whatever you decide. Maybe she had all the scar tissue after seeing Sam Altman being ousted by the board of OpenAI, but that is part of the changes that we're seeing in this market. Here is a great slide. Coatua is a fund in New York. They invest in public and private companies, and they created the Fantastic 40, this index of the future. What's interesting about this is they put both public companies and private companies, and I think that's important, right? And you can see how now the line between private and public, because of the valuations, because of the private markets, are in the same category. And you can't ignore anymore these companies. And it's a very important part of the narrative this index of the future, I don't know, David, if it reminds you of the Nifty 50, but we are in that period, right, where we are creating these index, right? Magnificent Seven, Nifty 50 was in 1968 or late 60s. Now we have this fantastic 40 from Couture. So this is interesting to see how this is evolving. Now, let me get back to the idea of big tech versus little tech, right? People have tried to separate this narrative, but the reality is they're not separated at all. In fact, big tech is very much involved in little tech, and all these companies, so NVIDIA, Google, Microsoft, have done hundreds of deals investing in these AI companies. So it's not a separate, they're all really connected. And here's this incredible slide that came out from Morgan Stanley that shows you how OpenAI is, has all these deals with all these large companies of hundreds of billions of dollars of co-investments. So remember, David, we just said that they closed a $122 billion round. Well, 50 billion of that is coming from Amazon, right? And they're saying 15 billion is cash, but they are conditioning the rest on having an IPO or reaching AGI. Another 30 billion is coming from NVIDIA. Another, 30 billion is coming from SoftBank. And so they all have these circular deals. And you know who doesn't like this $50 billion Amazon deal? Microsoft, right? Microsoft was the original, holder of OpenAI, and they said, wait a minute, you're supposed to use Azure. What do you mean you're doing a deal with Amazon with AWS? So now they're threatening litigation. So everybody here is it's interesting for those of you who do accounting, how to think about this. There was a prior era in the dot-com era where there was a lot of circular deals and, off balance sheet investments. And here we are in this world where there's a lot of this going on, a lot of investments from the big tech that book this as also revenue because they invest in you, but you're supposed to rebuy compute power from them. So it's like circular deals. And that's going to be interesting how that plays out. Maybe in a couple of years, we'll have another podcast and talk about how that ended up. Okay, so let's end up with this innovation in governance. The public benefit corporation is a really interesting structure. It's not new. It's been around forever, but essentially it was used in a prior era by companies like Patagonia and others that had some of a public interest to the environment or other public interest. But the new generation of AI startups basically said, look, we're not going to maximize just for shareholders as a typical corporation must if you're a board member. We're also going to create a public interest, and that interest is for humanity. They're saying, look, this technology is so important that it's for the betterment of humanity. And if it reaches AGI, we all owe it to humanity to make decisions in their favor, right? And so when OpenAI started, they started as a nonprofit in part because they said, we want to do something which has a public charter to always benefit humanity. And I think the narrative later is they realized that the nonprofit couldn't allow all the investment, all the money flow. and eventually they had to create a cap profit entity. And now they converted, which is a whole mess. But Anthropic started as a public benefit corporation, right? So OpenAI, right, now converted as a public benefit corporation. 26% is now part of the foundation, the original nonprofit. So ab initio, October 25, that foundation has $130 billion. Microsoft has 27%. SoftBank has 11%. Investors and employees have 36%, and Sam Altman has no equity, right? That rubs people the wrong way. It's like, well, what's going on? Does he have interest on the side? It's not a traditional story, right? And so we're going to have an interesting, Elon Musk, the whole point is like, he said, I gave $40 million to this nonprofit because to maximize AI for humanity, we didn't want Google to take care of this company to be maximally for profit. And now you're converting to a public benefit corporation. Wait a minute, how does this work? And it turns out instead of being Google, it's Microsoft who ends with all the spoils. And so there's this whole question of, well, if you can do a nonprofit and raise money that way and convert, why shouldn't every company start as a nonprofit and then convert later on, right? So there's a good, important question there. Anthropic is interesting, maybe because as they left AI, they had a difference of opinion on the values that Sam Altman had and Dario Amodei and his partners. So from the very beginning to do a public benefit corporation, but they added something when in the Series C.
I lost the video.
Evan, your audio. Your audio.
gone.
Okay.
Back. Yeah,
Okay.
back.
Sorry about that.
Yeah.
So essentially, he says the long-term benefit trust, what they're going to do is have people without any economic interest in Anthropic, but with information or at least benefit to humanity and other altruistic motives, they're going to select the board of Anthropic, right? And over time, it's going to select and nominate the majority of the board. So it's a very different structure. By the way, I have a podcast, the Boardroom Governance podcast. I just had Eric Ries, who is a person who wrote the Lean Startup and just wrote a new book called Incorruptible, which is exactly about thinking of new structures about companies and using examples like Novo Nordisk, which Novo Nordisk started 100 years ago, David, with a foundation that owns the for-profit entity. So it's not new. What OpenAI did, Novo Nordisk did 100 years ago. And, that was done by a Nobel Prize winner. And he tells an interesting story that if Novo Nordisk did not have that structure, it would have been acquired by another pharma company 3 years ago, and they would have lost the R&D. They would not have got the Ozempic and this new drug on. So it's really interesting. I think that's a good book. Interesting. It's coming out, I think, later in May, but it's about analyzing these anomalies or unconventional structures of companies where it's not only about maximizing a shareholder value. That's his criticism, that if you do a conventional company, no matter what you do, David, the financial gravity, right, is so strong that you inevitably going to do something beyond the mission of the company because shareholder value is so strong in the market, right?
Yeah.
So to summarize here, what we have is Anthropic, xAI, which was Elon Musk's company, initially was a PBC incorporated in Nevada. Interestingly, he merged that with X, which is the X Twitter company, and now merged it with SpaceX at 1.2 trillion, and now they're going public. So he's kind of busy merging everything. I wouldn't be surprised if we see a SpaceX at the end merge with Tesla, and we have one single company. Remember that Elon has got a compensation package worth $1 trillion if Tesla goes to 10 trillion or $8.5 trillion. So if he merges with SpaceX, maybe it's a case for him to get that out there. Anyway, that's pure speculation. But Inflection AI is another company from the UK, Mustafa Suleyman, who was also a PBC. That was acqui-hired by Microsoft. There was a lot of questions about that because that was one of the first acqui-hires where you do a license deal. It's not a pure acquisition for fear of antitrust retaliation. And there's been a lot of these deals. And this is kind of a trend where you see AI companies that are acqui-hired by the large hyperscalers, Google, Meta, Amazon, paying a lot of money for licenses and for talent and CEOs and founders, and not doing a proper merger, which avoids the antitrust oversight, but also, puts a lot of questions out there in the market. And, I always say this, the big question out there is China, right? What about China when they do the AI? Do they run for the benefit of humanity? What are the guardrails used in China? This geopolitical question is at the core, at least in the United States, in terms of thinking about development of AI. There's a big movement to disaccelerate the AI movement. A lot of regulators, I think, politicians are going after and saying this is too much. But, the other side of the coin is, well, how are we going to catch up to China? This is a big geopolitical race. And I think all the countries are in this, or at least the United States. And I know Canada, you have companies there, and Europe. So this is a big part of the story. Just to recap this OpenAI board fiasco, because I think we're in the middle of this. Sam Altman got fired in November of 2023. That created 5 days of chaos, real chaos. What happened here? The board of the company said, this is a vote of no confidence. They said he was not candid in his communications. David, as you and I know, that's the right of a board. The number one job of the board is to hire and fire the CEO. If they feel that's the way they can do it. And what happened is Silicon Valley insiders said this is the biggest board coup since Steve Jobs firing in 1985. There's a lot of pressure from all the investors that weekend, a lot of CEOs, tech leaders, employees, and certainly the employees kind of pushed back a lot. the CEO of Microsoft very quickly said, hey, Sam, hey, Greg, come over to work with us. No problem. We gave a standing offer. And then all the employees, 90+% of employees signed a resignation letter and told the board, if you don't resign, we're all leaving and we're going to Microsoft and this company's over, right? They had a tender offer at $86 billion on the other side, right? So they said, we don't want this goose, the golden eggs to be over. And the board resigned, except for one. And I think that was a deal just to keep some momentum there. And he returned, right, on Tuesday, Sam Altman. As they say, if you strike at a king, you better kill him. And he came back stronger. And that's where we are. I always call this a massive wake-up call on corporate governance. They announced later corporate governance reforms. They got new board members, more independent directors, corporate governance guidelines, conflict of interest policy, board committees. WilmerHale got in as a law firm to do a special investigation. They said there was a breakdown in trust, but the CEO's conduct did not mandate removal. So a little bit whitewashed that situation. Elon Musk obviously sued Sam Altman in 2024, and the trial is happening in a few weeks. So it's a big deal. As we just said, OpenAI just closed $122 billion at a $730 billion pre-valuation, $852 billion post. So the $1 trillion valuation is right there. Amazing what Sam Altman has done as a fundraiser. Impossible to deny that. And in October of 2025, this is really important, both the California and Delaware attorney generals issued statements of no objection to the recap from a nonprofit to a PBC after securing concessions. California says, hey, you got to stay in California because this is another golden goose for California. And they said, we're going to allow this, but you have to remain in California. Remember, a lot of companies have been leaving California. And Delaware said, hey, if you do X, Y, Z, and they brought investment banks, and there's questions about the process, but at least that was needed, required for OpenAI to convert. They got those concessions. That's the enforcer. Remember, as a nonprofit, the only person that enforces fiduciary duties of board members of nonprofits are the attorney generals. There's no shareholders. So I think that's really important. And now we can open up questions. I know it went very quick, but there's a lot out there, and happy to take as many questions as we can.
Wow. Thank you, Evan. Questions, everybody, go ahead.
David, would you like to make a comment first on what stuck out for you there?
Well, I just think things are evolving so rapidly that unless you keep up with this sort of day by day and certainly week by week, you're really not going to know what's happening, not only in terms of who's doing what to whom, but in how the governance structures and processes are changing in these corporations. So fascinating stuff. Unbelievable. Thanks again, Evan.
Yeah, and look, and there's a lot out there that we haven't talked about, but I'm sure there's a lot of questions from the listeners.
Yeah.
Yeah, please start dropping your questions in the chat. So from Elsie, Evan, what's your assessment of the pros and cons of the public benefit corporation legal status? How effectively does it support effective governance versus typical incorporation structures?
Okay, thank you. Great question. And maybe it can give me a little bit of time to explain what's a public benefit corporation. So a public benefit corporation in the United States, at least, is a recent creation. The first statute was, I think, in Maryland in 2010. Delaware approved public benefit corporations in 2013. So it's only 11 years away. Mm-hmm. And what it does, it's basically a change in the charter of a C Corp. And in the charter of the corporation, you say you have an obligation to, the board can make a decision in a public interest that you declare. So you have to state what is your public interest. In the case of the AI companies, they've said the public interest is to humanity. And so when the board makes a decision, they're not obligated to maximize value for shareholders. Remember, in the United States, at least in Delaware, that's been the jurisprudence, is that if you're a board member, you have to maximize value for shareholders. You have to take them into consideration. And so that's something that is very important. And so it's a little bit of a hedge here. You say, well, now you can take into consideration the public interest, and you can take into consideration all the stakeholders of the company. Now, here's a concrete example that just happened. Anthropic, right, got into this fight with the US government. And so the government said that they use Anthropic for the Department of War. And Anthropic said, we don't want our technology to be used for autonomous weapons, and we don't want it to be used for something else that was kind of bad into the company. Sorry? Surveillance of citizens. Okay. And the Department of War, I'm sorry, we are the Department of War. We can do whatever we want. And so they got into this spat, and essentially Anthropic didn't want to back down. It was a $200 million contract, and they didn't. And so the Department of War called the company a supply chain risk, which is a big statement for a US company, a leading US company. And if you were a shareholder of Anthropic, you can say, hey, Dario Amodei, why are you making the social mission bigger than the economic reason? We invest in Anthropic because we want you to make money for us. And therefore, you breach your fiduciary duties. And that could actually be litigated. And there is a case. Now, because it's a PBC, the board of Anthropic has a defense and says, hey, we are not here only to maximize value to shareholders. We also going to maximize the public interest of this company, and that is to maximize humanity. And we think this is a risk to humanity. So it gives the company, it gives the board a bigger leeway to make decisions. And so it's very interesting to think about it now. That may be the first case study. The other thing that hasn't happened is that the only person that can enforce a public benefit corporation decision is a shareholder, right? And in Delaware, at least, you have to have at least 2% of the equity of the company, or you have to have another threshold of a numeral, I think it's a few $1 million in shares of the company. So it's not a perfect enforcement mechanism. It's an enforcement mechanism, and it's never been enforced, the decision of a board to maximize the public interest versus shareholder, which is interesting. We may see down the line, Quinn, maybe in 2 years, litigation around this, right? But it has to come from a shareholder. And so it's interesting that that's the case. Now, Anthropic did something beyond that. And they said, we are going to do a long-term benefit trust, which is going to elect our board. And so that's a different, separate structure. And I think this is just a new iteration where companies and founders, and I just had this conversation with Eric Ries, right? In Silicon Valley, the value is really into the founders, the builders, right? They want to be the people running the vision. In Wall Street, in the capital, the institutional investors, they want to make the decisions, right? Because they run the show. So New York, in that regard, hates, like, for example, dual class share structures. And they say, no, we have to have more say than new founders. And so the prior generation, the Google generation, came up with dual class share structures. Now, remember, dual class share structures also have a long history, 100 years. It's not the first time it's used, except that in the tech industry, Google was the first tech IPO that used the dual class share structure. And it was a way for the founders to remain, keep decisions within them, and not have others, shareholders, telling them what to do. I think the PBC is the next iteration here where they're saying this is a stronger way. One problem of dual class share structures is that it's assigned to a person. So what happens when Mark Zuckerberg leaves? Well, turns out his voting shares are going to go to his daughters. So you have like a problem there, whereas in a public benefit corporation or in a foundation, it stays forever. So this is the Novo Nordisk scenario where you kind of structure it mission from the very beginning. And so I think it's interesting from a governance perspective to think about it. And for founders who are interested in keeping the mission of the company, maybe a PBC makes sense. I personally am a little bit, skeptical of the benefit of humanity, because I always say this, and I think I may have said it 2 years ago, that in the United States, we can't agree between Democrats and Republicans on the budget, and we're going to know what's best for humanity, right? But that's where we are. So it's going to be interesting to see the evolution of PBCs. And like everything, it's a negotiation. If the investors are willing to grant you that structure, then fine, you can get it. But not everybody gets it. I think you got to be a hot company, a hot founder, to be able to negotiate those terms, those structures. You're going beyond the traditional realm of governance, and that's not always easy. And so, like dual class share structures, it was reserved for the 20% of the leading companies. we had about 45% of IPOs that had dual class share structures. Now we're going to see whether PBCs stick, and at least it's stuck with this new generation of AI founders.
You had on your list, just to reinforce this about PBCs, you had on the COTU list that you showed
Yeah.
Ethereum and Bitcoin, which Ethereum is a foundation and it's not a PBC. So do you have any commentary on these future tech darlings that have different structures even from PBC corporation in general?
Yeah, so I would treat crypto in a different category because these are decentralized, and supposedly, Bitcoin and Ethereum at this stage doesn't have a group of founders, and it's out there, and there's a whole question on securities, on commodities, and I think a lot of people think it's not a security anymore, it's a commodity. So you don't have a group of people that are running it. Right now it's a pure technology, and if you believe in Bitcoin, nobody's in control. Right. And it's kind of a mathematical engine that, the rules are set by the blockchain, and that's it. Right. So I think it's a different structure in terms of governance. They have it there because they believe that if you think of the internet, if you think of money that's going to be in the internet, the next generation is going to have to use some form of change of money, and these are the bets that people are doing. I think the foundation model of Ethereum and others is very interesting because that follows another tokenomics model where when you issue, and there were like these ICOs, initial coin offerings that Ethereum did, where they distributed tokens to different people at a different rate. I think that's going to be something that we take differently, and I would put that in a different bucket. Let's say that.
Interesting. Fun one. If you and David were on the OpenAI board in November 2023, what would you have done differently?
Let's see, David, the voice of experience.
Yeah. Not sure. I don't know what Sam's crimes were, so it's not possible, I think, on the information we have to make a judgment on that. But over to you.
I mean, look, if the information was really damning and the CEO was lying and obfuscating and not giving you the right answers, then as a board, you do have to make the hard call if you lose the confidence of the board. Now, I think that board didn't understand the consequences, that it could kill the company, and maybe you have to run a process. Maybe they did talk to him, and I think they did, and they kind of thought that by doing this, and I think the vote was, I can't remember, but it was 4-3 or something like that, and they outvoted him, that it was going to be okay, and they could nominate a new director, and things were going to work out. That was a mistake in terms of thinking the consequence of the decision. So maybe, and now, post that event, maybe it's easy to make that call, right? But I think that's really the job of a director, to understand, who is in charge, what the CEO is doing. Is he lying? Is it true? What are the fundamentals? There were a lot of charges at the time that he was creating venture funds on his own name, that he was pitting people against each other. He was, a lot of the founders of OpenAI left, and there's a reason, right? There's a lot of happening, but he's shown when he's come back to build a lot of value. And I think that the interesting lesson about this is that economics beat governance, right? No matter what the governance was, the economics have won that over, and the pressure of the economics was so big, so much economic interest. And that's a dangerous precedent. And we'll see as this moves on what happens, because I think the story's not over.
It's a developing issue.
Yeah.
That's for sure. From Gordon, related to privates and secondary. So why would a startup want to go public if they can get funding through private markets? Is this only a consideration for a few select companies that are seen as, for example, an AI winner?
It's a great question. That is a question that every CEO of a hot or private company is having, right? they have first of all, you need a lot more revenue and a much bigger market cap to go public these days, right? Remember, when Microsoft went public, when Amazon went public, when Facebook went public, they were much smaller. Well, maybe Facebook was large, but in the prior generation, they were much smaller. Now you got to have a lot of traction, a lot of revenue to go public. But I would say that there is a lot of companies that have said exactly that. Why would I want to go public? If I can run my company whatever way I can, I've got a lot of patient capital with me. I can do whatever decisions I want. Nobody's bothering me. And the one thing and we're talking about this with Eric Ries in my podcast, the one thing that every CEO that has gone public complains about is that no matter what happens, every employee looks at the stock ticker. Every employee, every day. So if there is a downturn, the morale is very hard to maintain in those conditions. And we've seen this market has been as volatile as ever. And so remaining private doesn't put you in that category. So I think it's a very valid question. Maybe the answer is that if you can go public and your valuation triple, I always give the example of Airbnb. Airbnb, when it was a private company, was worth $30 billion, right? And people, and a lot of academics also wrote about how overvalued these private companies were. And there's a lot of questions about, like, these are just, Ponzi schemes by venture capitalists that are overbidding. Remember that, David? And they were overbidding, and the real number was not, and this unicorn was $1 billion, but in reality, they were worth 500 million or whatever. So when Airbnb goes public, it actually goes to $100 billion valuation, meaning that the public markets valued 3 times larger the valuation than the private market.
Yeah.
So that's a reason why you would want to go public. So this is why maybe SpaceX is thinking about it, because maybe their valuation as a public company is going to be 1.7 trillion. Who knows? I mean, this guy, Elon Musk, has got a company, $1.3 trillion, which is a car company, which is, more than every other car company combined. If you think that the public market is going to value you at a way higher number, and you feel that that's going to give you an advantage, and it gives you obviously the advantage of being now you got liquid, stock. And so it gives you acquisition currency. It gives you liquidity for employees. But I think if you're not in that category, then maybe staying private is a much better option.
Yeah. Well, that half the companies on the stock exchanges in both the United States and London have declined in number by 50% since the mid-90s. So on average, more and more people are deciding to stay private longer.
Yeah.
Now, there are real costs to being a public company.
Yeah, for sure.
You might get higher valuations, which offset them, but there are huge real costs that I don't think in our minds we really take into account. Say, go public. It's kind of the golden end of all activity, but in fact, it's going to incur a lot of difficulty within the operation. So, CEO,
there's a great case called MindBody, which is a software company that was public that operates software for gyms and yoga gyms and things like that. And the CEO of the company said he hated being a CEO of a public company because he couldn't sell his shares. The market would think that, he was offloading, and therefore he didn't have any liquidity, and he hated it. And then the company, when it went private, pre-E company went private, and there was litigation because the accusation was that the CEO led his company to be bought by Vista Equity, which is one of the private equity firms. And he was found liable that he kind of steered the process. And one of the arguments is that, when you're a public CEO and you go private, you make money at that sale. And then you make money again when they take you public for a second time. So that's interesting, right? Maybe that's advantageous because you make money twice instead of once. So there you go. That's another reason.
This has been I'm going to wrap up. Any final questions, comments?
Yeah, I was going to ask Mike. My pal Mike asked, is there any tax differences between a public benefit corporation, Evan, and a normal publicly traded company? Are they taxed differently?
No. To my knowledge, I'm not a tax expert, but I think the only difference is the charter of the corporation. Okay. And otherwise, it's still a regular corporation. There's other issues, in terms of the board and your fiduciary duties, but I think taxation-wise, it's the same.
Okay, thanks. Go ahead, Quinn. Take it away.
All right, we're going to we're going to wrap up with Evan here, talk about what's next, and then hopefully a couple of you stick around to show how we're eating our own dog food and building AI tools internally here.
Are we going to put up
So-
Evan's podcast sites so everybody can see them?
Yep, going to do that right now here. So this is Evan's podcast here, the Boardroom Governance Podcast. He was just talking about having Eric Ries, the writer of the Lean Startup. A lot of the language that's kind of seeped into mainstream culture around startups. And what would Eric Ries talk about when it comes to the long-term stock exchange? So public benefit corporations, Evan.
Yeah. So he created the long-term stock exchange about 10 years ago. And he realized that one of the problems that we just discussed in public markets is it's very short-term oriented. So he created a new stock exchange. There's the NASDAQ, there's NYSE, and then he created a long-term stock exchange that would allow you to make decisions in the long term. There are 3 listings in that stock exchange, and you can cross-list so you don't lose liquidity, but that's been an experiment that he's run, and it's up there, and it's backed by major firms, and he's very interesting in the way he thinks about governance in his own way.
So Evan has a podcast. He also has this newsletter that twins with the podcast. It looks like you highlight specific issues, so different cases and sort of curious happenings in the world of governance here. So
every month I put out a newsletter and I write about things in Silicon Valley. As you can see, there's a lot of fraud in startups. There's a lot of things there. In fact, let me tell you, I will be in Toronto on May 9th. May 9th. Rotman is doing a conference on venture fraud and venture litigation, and I was invited to speak there. So, if you're in Toronto, hang out and go.
So on behalf of everyone, on behalf of David, thanks for being a speaker today.
Yeah.
We will be sending the episode for you to review in the coming days. We will also add a link to Evan's podcast to reinforce your pursuit of being a value-added director. So
let me say one more thing that is interesting, maybe, and to David, I should say, my Boardroom Governance Summit is happening finally, August 26, 27 in Limerick Lane Cellars in Hillsburg, California, wine country. And so, I'm finally doing it. I've been talking about it for a while, but that's happening. So I'm excited about that too.
Great.
There you go. If you want to go and see the lay of the land in Silicon Valley or neighboring Silicon Valley. So what's coming up next? So last month we met with Francoise Bertrand. We were talking about crown corporations. This month we met with Evan to talk about one of the external forces that are impacting boards across the planet, whether corporate, not-for-profit, crown, and any type of board. And next month on May 12th here, we're going to be meeting with Greg Gubitz. So Greg Gubitz, he runs a charity called Big Life. He manages and does conservation work in Kenya, 2 million acres of the ecosystem in Kenya. And he's going to be talking about managing a high impact board, how to generate and build a great culture with volunteer directors. You don't want to miss it. So that's the regular programming. Thanks a lot for coming. See you on May 12th. And we'll be having Janet Bannister in June to talk about building boards from scratch.
Great. Thanks, everybody, for joining us. And thanks, Quinn.